What's up guys, it's your boy Hima. Welcome to another video, and in this video we're gonna talk about everything that is taxes. Okay, so before we begin, please hit the subscribe button if you're new to the channel. I talk about stock market, I talk about the crypto market, money in general, and of course taxes is a very important topic that we're gonna look into today, because we've all been naughty boys with cryptos.
You naughty.
You know that the governments, including the Australian government, have been trying to come up with new rules and regulations to track these crypto trading activities, because there's a lot of money going in and out, and they want a piece of it. So instead of, the good thing about Australia is that they haven't put any kind of tariffs on it, so we still can trade crypto, we can buy crypto, we can sell crypto. They just don't want it to stop, but they want a piece of your cake. Now I'm at the Australian Taxation Office website. I will put the link below. Make sure to go and read this, and in this video I'm gonna break down all of these points that they're discussing in their website, so you have a framework to actually work through, so you know what kind of things that you should be aware of, what kind of things that you should prepare before going and having a conversation with your accountant. And of course, that's the most important thing. I do not know your personal financial situation, so make sure to go and talk with your accountant after watching this video, and this video will give you a framework to work on it. Alright, so let's get to it. Alright, so now they're talking about 4 parameters that they're going to use to tax you on your crypto trading or investment activities. Right, so we'll look at the first one. So the first one is exchanging cryptocurrency for another cryptocurrency. Now basically what they're saying is, if you're using a cryptocurrency that you already have in your disposal to buy another one, which is an exchange, they're gonna charge you for the second cryptocurrency that you're gonna buy using your first cryptocurrency. For example, let's say you wanna buy Bitcoin using your Ethereum. Alright, and you already have an X amount of Ethereum, and you want to buy, let's say, $5,000 worth of Bitcoin from the Ethereum holdings that you have. So they're going to charge you for the Bitcoin amount. So let's say you buy $5,000 worth of Bitcoin using Ethereum, they're going to charge you for that $5,000. So that's your capital gain amount. The other thing is they're not actually specific as to how much, like what kind of a percentage are they gonna tax in that scenario. Like let's say you bought $6,000 worth of Bitcoin, and of course it is subjected to capital gains taxes, but by how much? Like, are they gonna tax the entire amount? Are they gonna give you a discount? They're not really specified on it. So that means we have wiggle room to work it out, and try to actually do something to save a bit of money. Now the second parameter that they're gonna tax you on is cryptocurrency as an investment. So let's say you bought Bitcoin in 2019 when it was at $3,000, $4,000, and you kept it and you haven't sold it. Now in that case, I'm pretty sure your capital gain is massive, right? So they're not gonna tax you for that, of course. But if you sold your holdings, all right, let's say your cousin had a accident and you needed the money, so you sold your Bitcoin to fund for the cousin's operation, and now they're gonna charge you for it. The minute it hits your bank account, it's considered an income, and they're gonna tax you for that income. But there is something that you should know. Just like stocks in Australia, if you keep a security for more than 12 months, which is an year, they're gonna only charge you for they're gonna only tax you for a discounted amount. So if you keep your Bitcoin for an year, more than 12 months, they're gonna only charge you for a discounted amount. But with stocks, it's usually 50%. Let's say you made a capital gains of $100,000 and you kept that stock for more than a year, they're only gonna charge you for $50,000. So they only will put taxes on $50,000. So same goes with crypto. If you kept it for more than a year, they're only gonna put taxes on a 50% of that capital gain. I hope I made this clear to you. Again, they're not very specified on what kind of amount that it is. With stocks I know it's 50%, but with crypto they're not really specified, so I think that depends on which tax bracket you are in, and that is why I told you that you have to go and talk to an accountant, because I do not know your personal circumstances. Okay, so the third parameter is the most important one, is staking or mining, or also airdropping. So staking and mining basically is, you're contributing to the network. Let's say you are a Bitcoin miner or a Ethereum miner or a Cardano staker, so you basically get paid in the said currency. If you're in Ethereum, you get paid in Ether. If you're working to Bitcoin, you're gonna get paid in Bitcoin. Now this payment is considered an income, hence it's taxed. So it is considered taxable income, and you have to pay taxes for any and all kind of rewards that you got by staking or mining it. And they're also using this term called airdrop. Airdrop, I'll explain what airdrop is. Airdrop is sort of some cryptocurrencies, they give you free coins for holding it or mining it. It's basically you don't have to necessarily work for it, they just give it to you for free. Let's say there's a new cryptocurrency out there, and most of the time the moderators will pay certain people to promote their cryptocurrencies, and that is called airdropping. So let's say I have a cryptocurrency and I'm paying a guy on TikTok to promote my cryptocurrency, and instead of paying him in dollars, I'm gonna pay him in the said cryptocurrency. So when it goes up in value, he benefits from it. So that's what airdropping means. So the last parameter is personal use. Now this is where they're telling you that they're not gonna tax you if you use a cryptocurrency to make a personal purchase. For example, let's say there's a Ultra Miami festival out there, and the tickets are going at a discounted price only if you pay using cryptocurrencies. Now in that case, you could go to your exchange and buy certain amount of Cardano or Ethereum and pay for the ticket because you get it for the discount. And in that case, they're not gonna tax you your cryptocurrency or your purchase for any kind of personal use, as long as you have the proof that you use the cryptocurrency to buy the said tickets. But however, they're saying that if you kept it for a longer period of time and then made a purchase based upon the time period that you held your cryptocurrency, you will be taxed. Now this is where it gets messy. Alright, so they're basically saying the quicker you get rid of that cryptocurrency asset, they're not going to charge you for the capital amount gain. But if you kept it and hodled it for a longer period of time and then you used it to buy a personal product like a concert ticket or food or whatever, then they're going to tax you for that capital gains thing. But they're not very clear on how exactly, what kind of things that they look in with for a certain transaction to qualify as for personal use. But they're just saying the more you hodl it, of course with time the cryptocurrency goes up in value, and they're gonna charge you the minute you dispose it, and they're not gonna care about whether you use it to buy a teddy bear or whatever. They're just gonna consider that as an investment. But of course, like I told you, you have to talk to your accountant, because I do not know your individual financial situation. So you can use this framework as reference. Now they're also saying one more important thing is that if you lose your cryptocurrency, if you lose your private key, and you can prove the fact that you were stolen or you lost it, then you can actually claim that amount as a capital loss. So basically you can reduce the amount of taxes that you pay if you can find out whether your wallet was stolen or actually you don't have the access to the wallet. So as long as you can prove it, they're actually giving you a criteria for you to consider that as theft or loss, and as long as you fill this criteria, you can claim it with for capital loss. I hope I made clear. And of course they're saying that then there's an important part, which is cryptocurrency used in business. I think that'll be a whole another new video which I'll have to talk about. So this one is for personal use only. I hope I made things clear for you. So to sum up, they're gonna charge you if you exchange your cryptocurrencies. They're gonna charge you if you kept it as an investment and you get rid of it. So the only way that you won't get taxed is if you kept your cryptocurrency without selling it. And thirdly, they're gonna charge you for staking it or mining cryptocurrency because it is considered paid income. And lastly, they're not gonna charge you for personal use, but as long as it's under $10,000. So those are the 4 parameters that they use, and of course they're also saying if you lose your wallet, you can claim it as capital loss. So I hope I was clear and I made some sort of sense to you, trying to understand this because you will need it, and the tax month is already here. It's June, so I'm pretty sure you wanna book an appointment with your accountant to go and talk to her or him about your situation. And of course, if you watch this video and you know now what kind of things that you have to prepare. So if you have been a miner, so you could say I've been mining cryptocurrencies, keep a ledger with you. Of course, you can access your ledger, so you know how much you got paid and for how long. And same goes with selling cryptocurrency. Let's say you sold your Bitcoin and everything. Depending on the app you use, you can find all of those transactions, and you can work out your capital, whether you made a capital gain or whether you actually lost money. So do that as well. And of course, the exchanging thing, same thing again. If you use a certain cryptocurrency to buy another cryptocurrency, you have that transaction in your transaction history. So make sure to take that to your accountant and tell them what exactly did you do with the cryptocurrencies. That way they know how to serve you better. So that's it for today's video, guys. Thank you so much for tuning in. I hope I made sense. This is a bit of information to take it in, but it's very simple. I'll put the link below so you can go and read it as well and use this video for reference before you go and meet your accountant. And with that, I will see you guys in another video. Good luck with your taxes. Don't avoid it. You have to pay your taxes, but yeah, good luck and happy trading.